Well, people, I'm starting to see the signs for a potential bounce to come. However, I'm seeing some wicked signs that tell me to not get trapped. All that and more on today's Stock Market Brief show, everybody. We're going to get right into it. All right, people, welcome back. Starting off with the market snapshot. One of the things that I want to call out today is take a look over here on the year-to-date column. Holy moly, Russell 2000. You can't call this a new bull market when it's down on the year here now in 2023. Absolutely bonkers type price action, and today was a wild day looking at the 11 sectors that make up the S&P 500. Yes, we got some movement in the tech sector and communication services, so that's positive. But look down at the bottom of the list here, you get utilities, which is a very outsized move to the downside. This was down 4.65%. And I'll tell you some, what's going on here that makes utilities really falling hard. But not only utilities, right? We also have consumer staples that fell too, but I want to show you this one, NextEra Energy. I've been showing you this since this breakdown over here, and this thing continues to collapse. We're looking at a yield of about 3.5% on this. It was down roughly around 10% today, but a little bit off the low, so getting some massive sell-side activity there in these utility names. Target made a new 52-week low today, cracking down 3.51% too. Okay, and then also the housing index was down on the day there too, as well as it's breaking down from this potential head and shoulders topping pattern, looking for a potential hit to that 200-day moving average. So real estate's getting hit, consumer staples is getting hit, utilities is getting hit. Well, that's because the 10-year yield is continuing to just jam itself higher. We closed at a new 2023 high here. You can see we talked about this chart on the prior video. As this thing continues to head up, it's not even that far off from reaching 5%, which means the TLT, or a bond, using this as the bond proxy, is coming into and around that green zone. I've been watching to see if we can come into that 80 level. But, we will see here if there's even more downside or if we can even reach there in the first place. The 2-year yield has reached and surpassed the 2007 area, and now it's at a new high that we haven't seen since 2006, just before all that crazy stuff took place there. If we take a look at the 10-year 2-year yield and the 10-year 3-month yield, you can start to see we are beginning to uninvert here. So we'll see if that trend continues, because there's typically a lot of warning signs, a lot of bad things take place once you be inverted for this long and then you uninvert, which are some of the charts that I've, shared over the course of time. I want to take a quick moment just to let you know to like and subscribe to the channel if you haven't done so already, and take a look over here at the people that support this channel. I got my Discord, all the Patreons that support that there if you want to learn more about that, and then also the trading platform I use. You got a little bit of a screenshot here of all the stuff that I offer in the Patreon. Once you sync up Discord, that's where I post all my stuff there. I don't post anything on Patreon, but the payment processor is there. Then we got Interactive Brokers is one of my partners. Click that link and take a look at their campus and then also their platform. They are developing a new platform. Kind of looks like Webull. Still a lot of work to do. They said that they have a lot of stuff in the pipeline, like rapid order entry, window management, layout customization. It's looking really good, and I'm pretty excited about this because it's been kind of a dinosaur platform, and now they're kind of coming to life where they're integrating, charting software from TradingView. So pretty cool stuff. Let's take a look now at the next chart, not the market snapshot. I wanted to continue on and look at some of the commodities, and I'm going to start here with oil. So oil took a little bit of a back seat today, despite even seeing the 10-year yield rise. And I wanted to really point this out because if oil is going to start taking a back seat here, and how we kind of came into this resistance and kind of pressing off. So if oil does start to fade and consolidate or move down, that could be potentially good for other stocks, right? We know that a rising energy prices and rising oil, and you have energy stocks as leadership, it's not really that good for other various stocks, which we've been talking about here on the show. If we take a look at the dollar also reached a new 2023 high, which it's been absolutely getting crushing gold as that move has been taking place. So you get rising yields, rising dollar, boom, you get this taking place in the price of gold. So this will be continuing to watch. It doesn't mean that gold's down and out. It's still actually really honestly performing pretty darn good given the environment that we're currently in when you look at this from a year-to-date perspective. I mean, it's doing better than, small caps at this particular point in time. Now, if I look at a little trend line right here, you can see that this might be in somewhat of a channel, and we're coming down to the bottom of that channel. So maybe potentially look at around that 1800, 1825 level there. Copper got absolutely crushed today. It was down 2.57%. I did the math and I looked how many times this year have we had a move like that. It's only been 6 or 7 times. I believe it was 7 times that we saw a move this big on a single day in the price of copper. And this is really being driven by that dollar that just completely shot up. Just take a look at silver was down almost 5% there. This BPGDM is the bullish percent index for gold miners, and just take a look how much this has been getting crushed. We have a subtle positive divergence that's building here in the RSI. The last time we were down at these levels was last year in October, and we started to see a big rally. So just keep an eye on this stuff, because if there is some sort of Fed pivot or something takes place where the dollar starts getting, consolidating or pulling back, gold miners could be a potentially good play. And same with if the yield backs off, utilities can be a very good play, and various consumer staple stocks as they've been getting absolutely just annihilated. Now, we're going to hop into the S&P 500 and talk about some of the things that I see from the more positive sign taking place today that we could very well be in for a bounce. We just went over, obviously, why we should be, worrisome and not to get trapped. But I wanted to talk about a few things. So we'll look at the market DEX here. This is the daily sum of deltas, across the entire market. And what you'll see here is we have some green bars showing up, so we're delta positive. And you can see as, the kind of price of SPY is kind of just curving itself right here, but it's still down. Perhaps something good may come here in the near future. If I take a look at the flow map, you can take a look at options flow, and there's a lot of call buying today, right, for the expiry of October 6th. So this is a pretty positive sign, indicating that, hey, potentially people are getting ready for, a bounce here in the market. Okay, if I take a look at the SPX on the daily time frame, we're still right around that lower channel, right? And we're still above these prior areas of resistance. And once resistance is broken, it can become support. So it's not really until we get down below, right, the 200-day moving average, this area of support, and the lower weekly expected move at 42.08, then things could get a little bit more scary. So we'll continue to watch that. Now, if I zoom in on the 65-minute time frame, I wanted to show you some of the things that are taking place. And what you'll notice here is that's the 5-day moving average. It's still declining. However, price did close above it today. So the longer we stay within this area, this is going to start to neutralize itself, and that could be a pretty good sign. And as you can see here, we have this pull, and now we have this consolidation. So if this flag pattern meets a measured move, we could very well come up to the upper weekly expected move, which is around 43.68 on the SPX. So that'd be a more positive sign going into, the remainder of the week. And then we have the upper daily expected move for the SPX at 43.20 just about. So this looks like it's very possible to tag in the near future for the S&P 500. If I show you the SPY, which is the Spider S&P 500 ETF, you can see the same thing going on here, where you see this wedging type pattern, and that we closed above the 5-day moving average. You have a positive divergence on the price momentum oscillator, and RSI currently kind of been building here. So watch for the potential pullback for the bottom daily expected move to hold. But if we can start breaking to the upside, that'd be a bounce that you'd want to be able to take advantage of. But given the context of the overall market from an intermarket standpoint, you just got to really manage your risk here, because if we start breaking down this low, watch out, because then we could come try to test these lows or take those lows out. If I take a look at the 15-minute time frame here on my TrendSpider app here, I have some gamma exposure levels. These can act as potential areas of resistance and support. As it stands right now, they're all kind of beneath us, other than one that's way up there at around 450. Okay, I wanted to call out that this anchored VWAP from this prior swing high, where price action kind of held as resistance. If we start breaking above that and holding, that still opens the door, right? So boom, boom, start looking for, maybe a break above it, then a pullback, right? Then start to see some strength, give us, an idea of where we we can manage our risk up into the upper daily expected move if it wants to reach there. If we start pulling back further, start to look at about 424, which is a spot gamma exposure level, but that also lines up with the lower daily expected move, which is just right around this prior low here. So if you are going long, yeah, it'd be nice to pick it up a little bit lower and play something like that. But just be aware that if we start breaking down from these levels, there's so many things from that intermarket standpoint that we got to be aware of. So there's positive things taking place, but there's heavy amounts of caution as we're still, as we discussed yesterday, in a negative gamma territory, okay, which basically means that we're seeing dealers, when the price goes up, right, you'll see more volatility is what this means, buy into it, but as we sell off, right, they'll also increase selling into that as well, increasing the amount of volatility, which we clearly saw today. Now, if I look at the NASDAQ composite, so this is a big broad market, take a look here how we're actually holding above the 5-day moving average. This is the same with the Qs, and it is flattening out here. So perhaps tech might be a way to go. And if I just draw a line here, you can see a potential inverse head and shoulders. If that fires up to the upside, we might have to go test this 13,650 level, which could be a measured move, right? If you just measure from the head there, and then boom, same distance, and then its prior resistance. So that could be a potential idea going into the remainder of the week there. And this is also taking place while we have a bullish divergence on the bullish percent index, blah, 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 right there on the RSI there in the NASDAQ 100. The bullish percent index for the NASDAQ composite still in very oversold condition. We also have a positive divergence that's building on the NASDAQ McClellan oscillator. You can see price is lower, right? But the indicator is telling us that there's a little bit of strength stepping in here. So there is a subtle divergence there as the summation index is still bearish. We have the NYSE summation index, another broad market. You can take a look at the summation index still pointing down, but the McClellan oscillator is also putting in a positive divergence there too as well, while the Russell 2000 just made a new just closed negative for the year for the first time there. SPX bullish percent index here is also in that oversold territory. If I'm looking at the percent of stocks above the 50-day moving average in the S&P 500, the reading is 12.2. So what this tells me that there's only 12% of the stocks in the entire S&P 500 that are above the 50-day moving average. And these get pretty overextended areas, especially when it gets down to around 10. You can see we got around here, and we saw bounces from these oversold conditions. Now, if I want to look at multiple different indexes and look at, where are they relative to the 20-day moving average, I mean, just take a look here at like the S&P 500. Sorry, the S&P 500 is down here, 10%, right? That's a very, very low portion right there. It means 10% of the stocks are above their 20-day. But just take a look, at most of these index, like the small caps, right? Boom. The mid caps, only 15%, 16% for the S&P 1500. Right here, the S&P 100, which are the larger market cap names, 12%. The Dow Jones, take a look here, only 10%. The NASDAQ 100, 17% of stocks, right? And then you have the NYSE at 19, and then you have the NASDAQ composite at 21 there. So all getting beaten down. The last chart I want to just close off with today is growth versus value. Now this chart right here, that's the Qs, okay? That's a NASDAQ 100. We're using Qs as the proxy, but down here is measuring the rate of change of growth over value. And when we see it cross down through the zero line, I mark those red lines all throughout the screen. Every time we cross down, you can see, boom, when we cross down, you typically get weakness or can get weakness in the Qs. The most recent one was right here where we started to sell off. On the flip side of that, when you get crosses above it, boom, you can see potential strength, right? It doesn't mean it has to happen, but we've seen it take place. And I just wanted to call out that we did cross above there today, seeing some positive strength from a rate of change perspective of growth over value. So is this indicating to us that, hey, potentially this inverse head and shoulder that we discussed can very well be setting up for a strong move? That's all I got for you on today's episode, everybody. We talked about, hey, why there could be a potential bounce underway, but also to be very, very cautious about it because of what just happened in the dollar and the 10-year yield. And you bet your I'm not. You better believe that will have an impact on growth stocks. That's all I got for you. See you later.